Picture this, a country where fishermen became billionaire bankers overnight. Where a nation of just 320,000 people, roughly the population of Tampa, Florida, accumulated banking debts worth 12 times their entire national economy. Where 3 banks controlled assets equal to 10 times the country's GDP, and nobody thought to ask, how is this even possible? October 2008. While the world watched Lehman Brothers collapse in New York, something far more catastrophic was unfolding in the frozen waters of the North Atlantic. Iceland, a volcanic island known for geysers, fish, and Nordic tranquility, was imploding in a financial catastrophe so complete, so absolute, that it would make Greece's crisis look like a minor recession. Here's what doesn't make sense. Iceland had everything going for it. The highest literacy rates on Earth. Gender equality decades ahead of the rest of the world. A social safety net that seemed bulletproof. One of the highest standards of living on the planet. And in just 72 hours, 3 days, it all evaporated. The Icelandic króna lost 50% of its value. Not gradually. Not over months. In days. ATMs ran out of foreign currency. Gas stations stopped accepting credit cards. Grocery stores couldn't stock imported goods. People who went to bed as comfortable middle-class citizens woke up effectively impoverished. Life savings vanished. Mortgages doubled, then tripled overnight. But here's the real mystery. How does a country with virtually zero banking experience transform itself into an international financial hub in less than a decade? How do 3 tiny banks grow to control assets worth $200 billion when the entire country's GDP was only $17 billion? And most importantly, why did nobody see this coming? Because people did see it coming. Economists published papers. Journalists wrote warnings. Short sellers bet billions against Icelandic banks. Yet the expansion continued. The government not only allowed it, they encouraged it. They defended it. They attacked the critics and called them unpatriotic. This isn't just a story about greed or incompetence. This is a story about what happens when an entire nation becomes addicted to financial engineering. When ordinary people start believing in magic money. When regulators become cheerleaders. When too big to fail meets too small to matter. And the most terrifying part? The patterns that destroyed Iceland in 2008 are repeating right now, in 2025, in ways you might not recognize. The warning signs are flashing. The question is, are we paying attention this time? Every financial collapse needs its cast of characters. In Iceland's tragedy, 3 figures stand out as symbols of how a tiny nation's ambitions spiraled into catastrophe. Dag Oddsson was Iceland's prime minister from 1991 to 2004, then became central bank governor during the collapse. A poet and novelist turned politician, he believed passionately in free markets. His vision was clear. Iceland would become the Singapore of the North Atlantic. He privatized the banks in the early 2000s, selling them to politically connected investors. When economists warned about explosive growth, Oddsson dismissed them as prophets of doom. He was still defending the bank's soundness weeks before they collapsed. Imagine if the architect of a system also became its only regulator. Jon Asgeir Johannesson represented Iceland's new business elite. He started with a small grocery chain and, through leveraged buyouts, built a retail empire spanning Europe. By 2005, his company Bogger Group owned British toy stores, Danish department stores, and dozens of brands. The formula was simple. Borrow cheap money from Icelandic banks, buy foreign companies, use those as collateral for more borrowing, repeat. Johannesson embodied the Icelandic dream, a Viking raider for the modern age, conquering not with longships but with leverage. Gerhard served as prime minister during the actual collapse. Unlike Oddsson, Hard inherited the crisis rather than creating it. On October 6, 2008, he appeared on television with a stark message. There is a very real danger that the Icelandic economy could be sucked into the whirlpool and the nation would become bankrupt. It was the first time a Western leader had publicly used the word bankrupt to describe their country. Hard would later become the first world leader tried for crimes related to the financial crisis. These weren't evil men. They were true believers who thought Iceland could defy economic gravity. To understand how Iceland fell so spectacularly, you need to understand where it started. Because this collapse wasn't random chaos, it was the logical endpoint of a very specific transformation. For most of modern history, Iceland was poor. Not developing nation poor, but harsh, isolated, and economically limited. The country gained independence from Denmark in 1944, and for 5 decades, its economy centered on one thing: fish. The waters around Iceland are among the richest fishing grounds in the world. Fish accounted for 70% of export revenues. Iceland was essentially a small-scale resource economy with a Nordic welfare state. This wasn't a bad system. By the 1990s, Iceland had achieved remarkable outcomes: near-zero poverty, universal health care and education, gender equality that made the rest of the world look medieval. But there was a problem: limited growth potential. You can only catch so much fish. The population was tiny. There were no obvious paths to greater prosperity. Then came the ideological shift of the 1990s. Across the Western world, financial deregulation became the gospel of growth. Margaret Thatcher had transformed Britain through privatization. The Berlin Wall had fallen, seemingly validating free market capitalism. In the United States, Glass-Steagall restrictions were being dismantled. The message was clear: the future belonged to lean, deregulated markets. Iceland embraced this philosophy with the fervor of a convert. The Independence Party, led by Odd Sun, came to power in 1991 with a mandate to modernize. The first targets were obvious: state-owned enterprises. Telecommunications were privatized. Airlines. Industries. But the crown jewels were the banks. Iceland's 3 major banks, Kaupthing, Glitnir, and Landsbanki, had been state-owned since their founding. They were sleepy, conservative institutions serving domestic customers. Boring. Safe. Small. Between 2000 and 2003, all 3 were privatized. But here's the first dark turn: they weren't sold to international financial institutions with deep experience. They were sold primarily to Icelandic businessmen with political connections and limited banking experience. The theory was that entrepreneurs would transform banks into engines of growth. The reality was that borrowers became bank owners. Bank owners lent to companies they controlled. The line between banking and business dissolved. But something unexpected happened. These newly privatized banks discovered international capital markets. In the mid-2000s, global finance was awash in cheap money. Interest rates were low. Investors were desperate for higher yields. Iceland's banks realized they could borrow enormous sums on international markets at low rates, then lend at higher rates for massive profits. The formula seemed magical. Iceland's banks would issue bonds in London, Tokyo, and New York. International investors, seeing Iceland's Nordic stability and AAA credit rating, bought eagerly. The banks took this borrowed money and invested everywhere: Icelandic businesses, foreign companies, real estate, derivatives. Between 2003 and 2008, the 3 banks' combined assets grew from roughly equal to Iceland's GDP to more than 10 times the GDP. Kaupthing became the 262nd largest bank in the world, from a country with fewer people than a small city. Landsbanki opened IceSave, attracting British and Dutch depositors with interest rates far higher than domestic banks offered. Inside Iceland, the transformation felt like a miracle. Unemployment dropped to nearly zero. Wages soared. Reykjavik sprouted luxury boutiques and gleaming towers. Real estate prices tripled. Young Icelanders with business degrees were offered 6-figure salaries. The critical context: Iceland's banking sector didn't gradually develop expertise over generations. It exploded from essentially zero to international significance in less than 5 years. And that explosive growth was fueled entirely by borrowed money. 2003 to 2005, El Despota. The story begins with a discovery. In early 2003, executives at Kaupthing Bank had a realization. Why limit themselves to tiny Iceland when they could access global markets? The first moves were tentative. Kaupthing opened a small London office. They began issuing bonds to international investors. The response was overwhelming. European and Asian investors, hunting for yield, bought Icelandic bank bonds eagerly. Money flooded in. What could these banks do with all this capital? The domestic economy was too small to absorb it. So they expanded abroad. Kaupthing bought FIH, a Danish bank. Landsbanki acquired Marion Capital in Ireland. Glitnir purchased stakes in Norwegian and Swedish firms. Icelandic tycoons, backed by cheap bank loans, went on European buying sprees. Back home, ordinary Icelanders noticed the wealth. If banks were expanding abroad, why shouldn't regular citizens? Currency restrictions were lifted. Suddenly, Icelanders could take loans in foreign currencies, particularly Japanese yen and Swiss francs, with much lower interest rates than króna loans. Here's how it worked. You're buying a house. Your bank offers two options: a mortgage in Icelandic króna at 12% interest, or Japanese yen at 3%. The monthly payment on the yen loan is half what you'd pay in króna. The banker assures you it's safe, everyone's doing it. Thousands made this choice. By 2007, 70% of Icelandic household debt was in foreign currencies. This created an invisible time bomb. If the króna weakened, these loans would explode in cost. But in 2005, nobody thought about currency risk. They thought about wealth. SUVs became status symbols. Luxury vacations. Iceland became one of Earth's most expensive countries. But wages were rising so fast that nobody minded. 2005 to 2007, La Arrogancia. By 2006, Iceland had transformed from one of Europe's poorest countries to one of its richest, on paper. The UN ranked Iceland as the most developed country on Earth. The bank's expansion continued at dizzying pace. Kaupthing's assets alone exceeded $60 billion, 4 times Iceland's entire GDP. But cracks were appearing. In February 2006, Danske Bank published a report titled Iceland, Geyser Crisis. The analysts were blunt. Iceland's banks were massively overleveraged. Expansion was unsustainable. The current account deficit was catastrophic. Iceland was heading for crisis. The response from Icelandic authorities was furious. Odd Sun called the report unscientific and accused Danske Bank of market manipulation. Icelandic media attacked the Danish analysts as jealous. The message was clear: questioning the banks was unpatriotic. Other warnings came. Fitch Ratings downgraded Iceland's outlook to negative. The IMF published concerns. Short sellers bet against Icelandic bank stocks. But bank leadership dismissed every critique. They published glossy reports showing strong balance sheets. They hired prestigious PR firms to defend their reputation. Inside Iceland, dissent was rare. The banks employed thousands. They funded political campaigns. Media outlets relied on bank advertising revenue. The banks sponsored arts festivals, sports teams, university programs. Criticizing them felt like attacking Iceland itself. And there was ego. Icelanders began seeing themselves as financial Vikings, conquering global markets. It felt good. A small nation that had been marginal for centuries was suddenly significant. The Utrisar Vikingar, the raiding Vikings, became cultural heroes. But the fundamental problem was worsening. Iceland's banks were borrowing short and lending long. They'd issue 3-month bonds to foreign investors, then use that money for long-term investments. This meant constantly refinancing, finding new lenders willing to roll over debt. As long as confidence remained high, this worked. But if confidence cracked, the structure would collapse instantly. By mid-2007, Iceland's 3 banks had combined liabilities of approximately $200 billion. The country's GDP was $17 billion. It's like a person making $50,000 a year owing $600,000. Except this was an entire nation. 2007 to 2008, El Collapso. The global financial crisis began far from Iceland. In 2007, U.S. subprime mortgages started defaulting. By March 2008, Bear Stearns collapsed. In September 2008, Lehman Brothers filed for bankruptcy. Global credit markets froze. Banks stopped trusting each other. Lending dried up overnight. For Iceland's banks, this was catastrophic. They relied on constantly refinancing short-term debt. When global credit markets seized up, they couldn't roll over their bonds. Foreign lenders simply refused to lend. The first domino fell on September 29, 2008. Glitnir Bank announced it was facing a liquidity crisis and requested emergency government funding. The government initially agreed to take a 75% stake. But this move, intended to stabilize Glitnir, instead triggered panic. If one bank needed bailout, What about the others? Within days, all three banks were in free fall. Rating agencies downgraded them to junk status. Stock prices collapsed. Foreign counterparties refused to trade with them. The krona plummeted. On October 6, 2008, Prime Minister Hard appeared on television. His face was grave. "There is a very real danger," he said slowly, "that the Icelandic economy, in the worst case, could be sucked into the whirlpool and the nation would become bankrupt." He announced emergency legislation allowing the government to take over the banks. But there was cruel mathematics. The bank's liabilities were $200 billion. Iceland's entire government budget was about $5 billion. Even liquidating every government asset couldn't cover 10% of the bank's debts. The next 72 hours were chaos. The government seized all three banks. Stock exchange trading was suspended. The krona went into freefall, losing 50% of its value in days. ATMs ran out of foreign currency. Gas stations stopped accepting credit cards. Grocery stores rationed imported goods. Icelanders with foreign currency mortgages woke up to find their debt had doubled overnight. A family with a 15 million krona mortgage suddenly owed 30 million, but income remained the same. Bankruptcy filings exploded. 2008 to 2010. Las consequências. The aftermath was surreal. Iceland, which weeks earlier had been among the world's wealthiest nations per capita, was suddenly dependent on emergency aid. The government negotiated a $10 billion bailout from the IMF and Nordic countries, the first time a Western developed nation had required IMF intervention since Britain in 1976. Capital controls were imposed. Icelanders couldn't freely convert krona to foreign currency. Leaving the country became complicated. Iceland had effectively become a closed economy overnight. Every Saturday, thousands of protesters gathered outside Parliament, banging pots and pans in the pots and pans revolution. They demanded accountability. In January 2009, the government collapsed. Hard resigned. Iceland held emergency elections. Criminal investigations began. Unlike the United States, Iceland took a different path. Dozens of bankers and executives were arrested. Eventually, 36 would be convicted and sent to prison. The former CEOs of all three major banks received prison sentences. But punishment didn't solve practical problems. Unemployment skyrocketed from nearly 0 to 9%. Emigration surged. Real wages fell 20%. Suicide rates increased. The social safety net was strained to breaking. The foreign currency mortgage crisis destroyed families. Tens of thousands faced unpayable debts on worthless houses. The patterns that destroyed Iceland haven't disappeared. They've evolved and spread. Look at the cryptocurrency boom of 2020 to 2022. The parallels are striking. Complex financial instruments few understand. Promises of revolutionary wealth. Mainstream adoption driven by FOMO, fear of missing out. And critically, leverage. Crypto platforms offered 20-to-1 leverage, allowing users to borrow $20 for every dollar deposited. When FTX collapsed in 2022, the similarities to Iceland were uncanny. A charismatic founder, insufficient regulation, over-leveraged positions, and sudden, complete collapse. Or consider China's shadow banking sector, non-bank financial institutions that act like banks but face less regulation. By 2023, these institutions had grown to $10 trillion, often funding speculative real estate projects. When China's property market began cracking in 2024 to 2025, shadow banks faced liquidity crises remarkably similar to Iceland's experience. Same formula: borrow short, lend long, assume confidence will hold forever. Even in traditional banking, risks persist. According to the Bank for International Settlements, global debt reached 265% of GDP in 2025, far higher than in 2008. Much of this debt is denominated in foreign currencies, just like Icelandic mortgages. Developing countries have borrowed hundreds of billions in dollar-denominated debt. If the dollar strengthens or rates rise too quickly, these countries face the same currency mismatch nightmare that destroyed Icelandic households. The warning signs are there. Extremely low interest rates for over a decade encouraged excessive risk-taking. Asset prices, real estate, stocks, bonds, reached historic highs relative to income. Leverage is everywhere. from corporate debt to government deficits to household balance sheets. And here's the most disturbing parallel: the same cognitive blindness. In Iceland, anyone who questioned the banks was dismissed as jealous or unpatriotic. Today, anyone who questions cryptocurrency true believers gets labeled a no-coiner. Anyone who questions stock market valuations is missing the new paradigm. Anyone who worries about government debt is told deficits don't matter anymore. This is the real lesson. It's not the specific financial instrument that matters. It's the collective delusion that this time is different. That we've discovered some new formula for generating wealth without risk. That fundamental economic principles don't apply anymore. Iceland was a laboratory, small enough that we could watch the entire life cycle of a financial bubble in fast forward. From euphoria to catastrophe in just 5 years. The same patterns are playing out globally right now, just at larger scale and slower pace. So what do we take from Iceland's catastrophe? 3 critical lessons. First, size matters, but not the way you think. Iceland collapsed because its banks became too large for its government to rescue. The same principle applies at every scale. If your personal debts are far larger than your income, you're vulnerable. If a financial institution is too big to fail, it's too big to exist. The mathematics doesn't lie. Second, complexity is a warning sign, not a feature. When financial products become too complex for experts to understand, that's not innovation, it's risk hiding in plain sight. If you can't explain in simple terms how something generates returns, you shouldn't invest in it. Third, collective euphoria is the most dangerous state. When an entire society agrees that wealth is magically increasing, that's precisely when you should be most skeptical. The moment everyone believes this time is different, is exactly when history is about to repeat. Iceland learned these lessons the hard way. The country prosecuted bankers, reformed regulations, rebuilt modestly. Today, Iceland's economy is based on tourism, fishing, and renewable energy, real activities producing real value. The question for us is, will we learn from Iceland's collapse, or will we have to experience our own? If this video made you think differently about finance and risk, hit that subscribe button. What modern parallel worries you most? Crypto? Government debt? Leave a comment below. Understanding how Iceland lost everything might be the key to making sure you don't lose everything too. Thanks for watching.